Hello and welcome to Morningstar. I'm Emma Wall and I'm joined today by Job Curtis, manager of the City of London Trust, to give his 3 stock picks. Hello, Job.
Hello.
So what's the first company you'd like to highlight?
My first company is Hammerson, which is a real estate investment trust.
And why do you like Hammerson?
Well, I like Hammerson because it's on a discount to its net asset value of almost 20% at the moment. It invests purely in retail property. It's 25% in France, the other 75% is in the UK. I think there's an opportunity ahead of the June 23rd referendum when there's a lot of uncertainty on property stocks at the moment, and as a result the share prices have moved sideways, been slightly weak, and yet I think the quality of Hammerson's assets, which are not just shopping destinations but also entertainment destinations for eating out and leisure activities generally, I think those quality of assets means that they will be in use come what may after June 23rd, whatever the outcome of the referendum is.
Now, commercial property, the index itself has done very well over the last couple of years, but that tends to be concentrated in the southeast, that index. Well, you mentioned there that you're looking, there's some global diversification looking in France. Does that help you sort of diversify your revenue streams and indeed keep that growth going?
Well, Hammerson's only one stock within our portfolio, so it's really a pure play on retail property, but it has, as you say, got 25% in France, which is a help, and it's got good quality assets in France. But I think I'm looking at really as a pure play of retail property. I think there's concern that the internet is taking money away from the high street, which undoubtedly it has. But I think if you've got high quality retail assets, these are kind of destinations that people go to entertain themselves, to eat out, you know, go to cinema as well as shops. So I think they will hold up despite the growth in the internet.
And what's the second stock today?
My second stock is Pendragon, which is a motor retailer, again slightly hit in the uncertainty ahead of the referendum. But I think, you know, car sales have been strong in recent years, but I think they're set to continue to be strong given low interest rates and the way that people can finance purchase of both new and used cars. And Pendragon is our largest car retailer in the UK. It's well managed. It's on a very cheap valuation. The price-earnings ratio is around 10 times, and its dividend yield is approaching 4%. So I think it offers very good value at these levels. Now,
as you alluded to there, autos is one of the sectors where people are slightly nervous as there is a Brexit, because at the moment there are no tariffs, are there, between the UK and the rest of Europe with auto trades, but they could go up to sort of 20%. You think this is not a concern, however?
I think it's unlikely that tariffs in traded goods would occur, particularly because Europe has a big surplus in terms of car sales, and we buy many more Mercedes, etc. Obviously, we do, though, sell quite a few cars into the continent, often though from German manufacturers and Japanese manufacturers like BMW that owns Mini. But I think the real concern is that the pound could fall quite significantly if we leave Brexit, and that would make imports more expensive. But I think sometimes, you know, these factors get reflected in valuations, and certainly the Pendragon share looks very cheap at the moment in my eyes. And if we do stay in, of course, then those scenario doesn't occur, and the betting odds at the moment do suggest 2-1 that we will stay in.
And you get a nice share price bounce.
You should do on that basis. It begin to get anticipated in the run up to the vote, but you should do, in my opinion.
And what's the third and final stock?
The third and final one is an old favourite of mine, which I've talked about in the past, but Taylor Wimpey, I think, still looks attractive. It had a very attractive, stunning performance in 2015. It produced a return of approaching 70%. It's moved sideways a bit this year, but it's very strongly positioned. It's got a 5-year land bank. There's a lot of demand for housing across the country. Generation Rent wants to own. And with low interest rates, it's affordable. And Taylor Wimpey's average house price is £265,000, so it's not affected by the what problems there may be at the top end of the London housing market. So it's certainly attractive from a dividend point of view. They've outlined a dividend policy stretching many years, and they've actually upgraded the amount of money they're intending to give back to shareholders. So it's yielding slightly over 5% at the moment.
Job, thank you very much.
Pleasure.
This is Emma Wall for Morningstar. Thank you for watching.